Of the 150 odd videos I've posted on my channel, one of the most watched is this one, where I've used a combination of momentum and value indices to construct what I believe is a lifetime portfolio. Now, I'm sure some of you have already seen it, some might have even invested based on it, and that includes me and the two SIPs I've been running. One is a Nifty 500 Value 50 index that's been on since December of 2023, and also an earlier one, a Nifty 200 Momentum 30 fund from April of 2021 onwards. Now, especially with momentum, everything was going absolutely fine. In fact, it was more than fine. So when I first started, the NAV was 10 point something. This went up and up to a little over 25 in September of 2024 before a lot of it came crashing down to as low as 18, and now the NAV is somewhere around 20. So I guess it's a matter of perspective. I can either beat myself up from the 28% drop in NAV in those last 6 months, September 24 until March of this year, or I can be satisfied with that NAV run from 10 to 20 over the past 4 years, which gives me an yield of 90%. So look at it the way you want to, but there's no denying that this ride has had its fair share of ups and downs, which makes this the perfect moment to not just revisit, but also revise our strategy and number from that original momentum value video. Please recall my original premise was rather simple, and it started with the observation that both these indices, momentum and value, are weakly correlated and there are big gaps in each indice's annual performance. This then supported my core argument that a long-term investment in these indices has the potential to build a passive, stable, yet remarkably powerful portfolio experiment. And like any experiment, there are revisions. And the modifications I've made in this video are as follows. So firstly, the timeline has been extended. The earlier video was until 2022, but this one here is updated until April of this year, that is the 25th of April to be precise. And then secondly, I've also changed the index. I think it was the Nifty 200 M30 in my previous video. Well, this time I'll be using the Nifty 500 Momentum 50 index and the Nifty 500 Value 50 index, as both these indices represent the broader market. To help out, I've attached the worksheet with the raw data in this video's description, so feel free to access it, download the file, and use it the way you like it. With that said, let's begin. Let's start with a question that I'm asked quite often. Where do I source the index values that I share in a lot of my videos, and how does one extract them? So this one's very simple. Firstly, access this website, niftyindices.com. On the top nav bar, you'll see reports. Within that sub-menu, click on historical data, then tap on the orange drop-down and select total returns index value. I normally use TRI, which is PRI plus dividend. And if you don't know what PRI TRI is, then please use ChatGPT. I then select equity from the next drop-down field. The index one wants data on, then the dates, and click submit. You'll instantly see a series of neatly organized daily data. Just download it on a CSV file, run simple Excel formulas to extract month-end value. नहीं तो यहाँ भी ChatGPT use कर सकते हो, and that's it. That's exactly how I extract index data for use in many of my videos. With this, you can pull out data for something like 100 plus indices. I use it all the time, and with this part of the process clear, let's check out what these numbers tell us. We start with momentum first, and very clearly the last 6 months have made a deep dent on the trailing return numbers. But you know what? Statistics can be very deceiving. Take the last 5 years for instance, and we see that the Nifty 200 Momentum 30 index has grown by some 26%. Acha hai na? But one should also take stock of the fact that 5 years means April of 2020, when the stock markets were at its lowest, all thanks to COVID. But still, if one examines the trailing returns over longer periods of time, say 10 years, it comes to around 18%, which I'll say is a lot more realistic and acceptable when examining a broad-based momentum index. Likewise, the value indices over the long run have given around 15.5%. So that's again a suitable expectation for us to have here. I also looked at this data on a rolling return basis, which I think is a better representation of returns. So very clearly, the momentum indices have done better than value over longer periods of time. And I'm sure as you look at this table, some of you are thinking, why even bother with value indices, and why not put everything into momentum itself? It's a very valid question, and before I use numbers to explain this, it's important for us to recognize that every strategy, growth, value, momentum, low volatility, dividend. Every single strategy will and does go through ups and downs, which is why it's always better to look at information over a longer stretch of time. Which brings me to 5paisa, the sponsors of today's video and one of India's leading online trading platforms that's trusted by over 45 lakh users. 5paisa combines technology, affordability, and innovation to deliver a seamless investing and trading experience across stocks, mutual funds, ETFs, commodities, and much more. One of their standout features is the ability to pledge mutual funds and ETFs as collateral for F&O and day trading, which means you can do a lot more with your capital without liquidating your long-term holdings. And because only the required amount gets pledged and not the entire portfolio, you have a lot more flexibility and control. This feature is particularly beneficial for investors with a sizable mutual fund or ETF holding who also want to actively participate in short-term market opportunities without disrupting their core portfolio. Additionally, 5paisa also offers ultra low cost brokerage plans across equities, currencies, and commodities, zero commission mutual fund investing, a robust mobile app that helps you trade on the go, powerful portfolio analysis tools to track and optimize your investments, and much, much more. So, whether you're just getting started or are looking to take your trading game to the next level, 5paisa offers the tools, pricing, and technology to help you make smarter investing decisions. So what are you waiting for? Check out 5paisa now, and as always, the link to the platform is available in the video's description. Alright, back to the video, and I think the big question was, if momentum has done a lot better when compared to value over the past 10-15 years, then why not go all in on momentum? As I said, it's a very valid question. And if one feels strongly about it, then instead of a 50-50 as I proposed in my previous video, one can try having a mix, say allocating 2/3 in momentum, while 1/3 can go into value, or maybe a 60-40, 75-25, and so on. Now, the reason why I propose a balanced allocation isn't based on emotions. It's actually very number driven, and the benefits of this become clear when we examine the data on an SIP basis. So let's stick to 10 years and say I had started an SIP, 10,000 rupees a month in both these indices on the 1st of April 2015. Now, that's an investment of 12 lakhs spread over 120 months. And as of 31st of March this year, I would have accumulated a corpus of 35.6 and 38 lakhs respectively in each of these indices. Percentage wise, this comes to an annualized return of 19.9% for momentum and a slightly higher 21.1% for value. Acha, sach bolna, you didn't see that coming, right? आपने सोचा होगा the returns from momentum would be a lot higher than value, but no, that's not what really happened. It's easier to understand this visually, and notice how between Jan of 2018 until the end of 2022, in this period, notice how the momentum index has doubled, more than doubled, while the value index remained pretty static. So what essentially happened here is that our monthly investments into the value index were accumulating units at a low NAV during this 2018 to 22 period, and when the big jump came in 2023, these units grew by 300% in value, generating big money for these investors. Remember what I had said earlier? Every strategy and therefore every index will go through a period of ups and downs, and that's exactly what happened with momentum and value, which is why I think you'll be better served with a combination of these two. And if you can do this on an SIP basis, then it's even better. Actually, let's do this. Let's revise the calculations, and just like I did it in the previous video, we'll stick with a 50-50 combination. So half the money, say 5,000 rupees, goes into the Nifty 500 Momentum 50 index, while the balance 5,000 is allocated to the Nifty 500 Value 50 index. Now, on an SIP mode and over the past 10 years, this combination has given us an annualized return of 20.6%. So technically, standalone momentum, standalone value, and a 50-50 combination have given us about the same returns in terms of percentage. But what's interesting to see here is the journey it took. Understandably, there were some good patches, some bad patches along the way for both momentum and value, and having a 50-50 combination kind of smoothens that journey. In fact, I've captured a few of the itchy periods in this table here, and the particular areas I want all of us to focus on are the gaps in performance, which also showcases the weak correlation one sees between value and momentum. For example, and let me take a recent period here. Okay, so between October of 2024 and until now, that is April of 2025, notice the momentum index is down 25% while the value index is down by 13, maybe 14%. So that's a big gap of 11.5%. Now, there have been many occasions in the past where such big gaps have opened up, and that's generally the time when SIPs do their work, helping investors grow their absolute portfolio and reducing volatility in the process. So, to put everything together, I'll say there are a few morals to this story. Firstly, the hypothesis that started all this inquisition is still valid. That is, momentum and value are not tightly correlated, and we have seen evidence of that with glaring gaps in performance over specific time frames and also on an annual basis. Secondly, on an average holding return basis and over 19 years, momentum has done extremely well with 18-19% returns with a very high performance probability of 15% plus. So do factor this historical detail into your calculations. Both indices, momentum and value do offer some balancing act that can help us reduce the portfolio's volatility levels, and I'll leave it to you whether you want to do 50-50, 60-40 or some other ratio. And finally, we have looked at the SIP strategy around this, which provided me even more comfort that systematic investing is the best, safest and the most logical way of investing in equities. The last part of today's video goes back to something called a switch strategy, which I had covered in my previous video purely as an experiment. I must have received over 100 comments asking me whether by switch I meant fully exiting one index and using the proceeds to enter the other, and the answer to that is yes. That's exactly what I meant. After all, switch का मतलब ही होता है on off. So in the same way, you're either all in or all out. My apologies if my earlier explanation was a bit unclear, but to tell you honestly, I think there's nothing more confusing than trying to time a switch between momentum and value. Believe me, I've tried to find a method for it, but honestly, it's like I'm not sure what I'm really doing, which is another reason why I advocate the balanced approach, that is, take a bit of momentum, take a bit of value, let's say 50-50, and use this simple strategy to potentially make a returns CAGR of 17, 18, even 19% over longer periods of time and without the use of active intervention. But if you must, then one area you can explore is to go easy on momentum funds when the price earning multiple, the P ratio is on the higher side, let's say 24 and above. In such a case, you can opt to pause your momentum SIPs. Definitely don't invest any lump sums when the evaluations are so high. And for the funds that remain, you can either move them into value or else you can park them in a relatively safer fund like a liquid money market, or at best an equity savings fund. My main point is I don't think too much of meddling will help investors over longer periods of time. So I'll leave it at that, but I sincerely hope these numbers have inspired some more confidence in you, especially after the massive 25-30% fall in momentum and a more sedate 17% decline that value endured over these past 5-6 months. That said, please do explore 5paisa. The team there has been doing a lot of good work in terms of tools, features, and pricing. The link is available in this video's description. And if you like this presentation, do share it with your friends and colleagues. Don't forget to subscribe to my newsletter, and I'll see you very soon. Until then.